Hello and welcome to this Association of Corporate Treasurers webinar sponsored by Chatham Financial. Interest rate management has seemingly spent many years in the wilderness whilst interest rates were at historic lows with no immediate increases on the horizon, and corporates have tended to allow all debt to float. However, the interest rate environment has changed over the last 12 months, and we are delighted to take this opportunity to discuss with a panel of experts not only how the market conditions are changing, but also what strategies you might adopt to respond to the move to a rising interest rate environment. In this webinar, we'll be discussing the practical aspects of interest rate risk management, covering execution and pre- and post-trade documentation, as well as some regulatory aspects that you might want to consider. My name is Sarah Boyce, and after many years of working in corporate treasury, I now work on providing policy and technical support here at the ACT. And firstly, for those of you that are new to our webinars, a little housekeeping. The webinar will last for 45 minutes, and we would like it to be as interactive as possible. So please do submit your own questions. You'll see a button on your screen that allows you to submit questions, and we'll try to tackle them as we go along. So don't wait until the end to send them in, but please submit as you think of them. Just by the way, we won't mention your name or company, so please do feel free to ask anything. We can't guarantee to answer it, of course, particularly if you want to know where base rate is going to be in 6 months' time. There is a menu bar across the bottom of your screen that allows you to open various windows, and you can move those around your screen, resize them or minimize them. The yellow button with a question mark is for help if you've got any technical difficulties. The purple Q&A widget opens a new window, which is the one that you can send the questions to us in. And then there is a resource button as well, which is where you can download further information about this webinar, other events in the ACT calendar, and related documents on interest rate risk management. I should add that a recording of this webinar will be available on the ACT website in a couple of days' time, along with a copy of all of the slides. Right, so moving on to today's agenda, I am delighted to welcome on International Women's Day an all-female panel, purely more by luck than judgment, it has to be said. But I'm very delighted to welcome Catherine O'Brien, who is VP Treasury at Dubai Aerospace Enterprise. She's the head of the Treasury team based there. Svenja Schumacher is Manager of Risk Management Advisory at Chatham Financial and is a member of their corporate advisory team here in London. And finally, Carolina Windies, who is Director of Global Regulatory Solutions in Europe for Chatham Financial, and she heads their Global Regulatory Solutions team. So, as I say, we have a triple-handed presentation from Svenja, Carolina, and Catherine. And so, without further ado, let me hand over to Svenja to kick off.
Thank you very much, Sarah, for the introduction. So many of you might not be familiar in terms of what Chatham Financial does. Therefore, I'd like to give you a bit of background information on what we're working on a daily basis. So for over 25 years, we've approached the debt and derivatives market as the expert at providing financial risk management solutions. We serve roughly 2,000 clients annually across a wide variety of sectors and industries. And we work with private equity and real estate funds, financial institutions, and especially in the corporate sector, we work with some of the global companies, but we also partner with smaller corporations, both on the public and private side. On the bottom-hand corner of the slide, you can see some of the statistics from past year. So last year, we structured and executed derivatives worth over $500 billion every year, and our system produces 30 million valuations. And on top of that, our system also provides 620,000 journal entries for hedge accounting every year. When we look a bit closer in terms of what we are doing in the corporate sector, we partner with organizations and advise them on how to best manage their financial risks. We would normally support them in terms of assessing their exposures, help them quantifying their risk, both like cash flow at risk and value at risk, and we help them define hedging programs which are in line with their objectives. In many cases, as I mentioned on the previous slide, we also end up executing derivative transactions on behalf of our clients. Since we are in the market on a daily basis, this allows us to have a very good insight to negotiate fair terms with the bank. We sometimes like to refer to this as a wholesale versus retail approach, which allows us to negotiate better conditions as opposed to a corporate who might only execute an interest rate derivative upon every refinancing of every couple of years. In order to support the execution process, we offer pre- and post-trade advisory services, both for legal and regulatory clients, regulatory topics, where we help our clients navigating the complexities for EMIR and ISDA negotiations. And finally, we also have our valuation hedge accounting services that are provided by our system, Chatham Direct, and this is supported by our in-house hedge accounting experts.
Okay, this is Catherine here from Dubai Aerospace Enterprise, or DAE for short. Just by way of background, Dubai Aerospace Enterprise is one of the largest, or in the top 10 of the aircraft leasing companies globally. I myself have worked in the sector for over 8 years, formerly with AWOS, which was acquired by DAE last year. Aircraft leasing is a growing industry. I myself am based in Ireland, where it is a significant hub for aircraft leasing. It is estimated that about 60% of worldwide aircraft that are leased are either leased, owned or managed out of Ireland. That's about $120 billion of assets. In context, it is estimated that an airplane that is leased by an Irish company takes off every 2 seconds. DAE itself is a small company in terms of people. There's approximately 140 of us, spread out through Dublin, Dubai and other locations, but we manage a book of assets of about $14 billion. And these assets are aircraft, over 380 in total, and they are your airplanes that you take off in every day, whether it's a short haul or long haul flight. We call them narrow bodies, wide bodies and regional jets. Our airline customers are located in over 55 different countries, with about 113 of them in total. I would note as well, we are a very highly leveraged business with over $10 billion in debt, and over 70 lenders, again, very geographically spread. From our perspective, with that level of debt and being so highly leveraged, interest rate risk management is one of the key items that keeps us busy in our corporate treasury function.
Before we jump straight into the topic, we would like to have a small poll in terms of what you think and what interest markets will be doing in the UK this year. So the question I would like you to answer is, I think you can click the little voting buttons here, is how many interest rate hikes do you think we will see for GBP in the rest of 2018? Do you think there will be either 0 or rate cuts? Then click number A. Do you think there will be 1 rate hike? It would be B. 2 rate hikes would be C. D would be 3 rate hikes, or do you think there will be even 4 or more rate hikes? This would be option number E.
Okay, thanks for that, Svenja. I think it'll be really interesting to see the results of this, and hopefully the technology will work for us. Because I think that a lot of people that are now working in Treasury have never really been exposed to rising interest rate environments, and also that many corporates have really fallen out of the habit of managing their interest rate risk. Particularly, it's going to be relevant for those organisations that are perhaps more cash constrained. As Catherine mentioned, if you're very highly leveraged, interest rate risk management suddenly becomes very important as interest rates go up. And the other thing that I observe is that things like covenants can very rapidly be impacted if you don't have your interest rate risks managed.
So let's see what the audience thinks. So we can see a bit less than 10% expect there will be no rate hike or even a rate cut. Option B, which is by far, by quite a bit the most popular one, is roughly 50%. Thinks there will be 1 rate hike. 2 rate hikes are about 37%, and a small minority thinks there will be 3, 4, or even more than that. So unfortunately, I can't tell you what the solution is. If I were able to, I would probably not sit here at lunchtime in the ACT's office, but rather in my little hut on the Caribbean. but I can tell you in terms of what expectations are currently priced in the market. So just checking Bloomberg this morning, we could see that there is potentially an interest rate hike expected in May, and there's also the possibility for another one later this year, potentially in November. So I think the majority of the voters in this poll already clicked 1 or 2, and this is also in line with market expectations. So let's have a look in terms of how interest rates have developed in the past few years. What you can see on this slide here is what we would internally refer to as the Harry chart, due to lack of a better name. So if you do have any suggestions, feel free to reach out to us. The blue line you can see at the top and the bottom is the historical value of the forward curve. So, the historical fixing. On the top we have the fixing of the 3-month GBP LIBOR, and at the bottom the historical fixing of the 3-month EURIBOR. And the orange bit at the end represents the current forward curve. And the little gray hair you can see on both charts represent the various forward curves at the various past moments in time. So if we quickly remind ourselves, what does the forward curve actually represent? So it represents, on the one hand, the market expectations. This is where participants think where the rate is going to go. And on the other hand, it also represents the rate levels which you would be able to lock in now via an interest rate swap. So a swap contract being a derivative that gives you the possibility to lock this rate and not being opposed to any other rate movements. So what does this chart tell us? It shows us the absolute level. So if you compare it in the historic context, we can see that both in GBP and in Euro, we are currently at historic lows, with EURIBOR still being negative until mid to end of 2019. But more importantly, it actually shows us that we have seen that since 2009, forward curve actually has always indicated future higher rates than what has actually been crystallized by the market. As a result, if you entered into an interest rate derivative during these years, you locked in a higher rate than what you would have received if you had stayed floating. And this also means with these interest rate derivatives, your swap will now potentially have a very negative mark to market and will be a huge liability to you. So some of the comments we do here when we talk to treasurers and CFOs is, why would we actually hedge if on average and statistically it means we have to end up paying more than if we stayed floating, which again leads us to another quite interesting finding of the chart. So if, for instance, we look at the market environment before 2009 and also to a certain extent to the environment where we are at the moment, is whenever we were in a rising rate environment, the forward curve effectively has under-predicted the actual rate movement of the index. And whenever we were in a market environment where there were falling interest rates, so post-2009, the actual forward curve has always over-predicted where the market ended up going. What we are left with is a bit of a philosophical question on the purpose of risk management. Is it about foreseeing what the market is going to do and take a position on that? Or is the pure task from a treasurer to remove the risk and just lock in the current level without any thinking about what rates are going to do?
All about certainty.
Yeah, exactly. So we can't answer this question for you, but what we can say is in terms of what we are seeing in the market and the conversations we do have with treasurers and CFOs. So one point we noticed over the past couple of months that there has been an increased focus on interest rate risk management, whereas probably in the past year or two other topics, like for instance the UK's vote to leave the European Union and topics like FX risk management might have taken priority over interest rate management. Secondly, one thing we notice what still causes headaches to treasurers are floors and financings. So not only do floors make the actual debt more expensive, it also makes it a little bit trickier to hedge this, and we will get to this point a bit later in the presentation as well. And thirdly, one point we noticed that our clients are doing is an increased level of forward hedging, which is mainly in relation to expectations that rates are increasing at a quicker pace than it's currently indicated, and which helps treasurers to remove the volatility of, for instance, future bond emissions. So if we now look at different points, what we would normally find, which are documented in a policy document. And some of those we've already touched upon in previous sessions with the ACT, for instance, when it comes up to objectives and purpose of hedging or the capturing and the quantifying of risk. In this session, we would like to focus a bit on the what and the how when it comes to hedging interest rates. And Carolina will also give us later on a little bit further insights in terms of what to keep in mind on the regulatory and documentation side of things. But first of all, we would like to hear from Catherine on how she answers the what and the how for Dubai Aerospace.
Thank you, Sonia. Yes, I think for every treasurer, you can get into a lot of philosophical pondering about what you want to hedge and how you want to hedge it. Ultimately, you will have some policy view on this, and you will know that the board and your executive leadership team will also have views. From our perspective in DAE, we have a lot of debt. We're highly leveraged. We source our financing from quite a broad range of sources. We tap the capital market through bond or private placements, term loans. We have a lot of bilateral and club loans and revolving credit facilities. So our financing comes from different sources. It covers a broad range of tenors. And we are dealing with a lot of very different lenders who might have very different motivations in mind in terms of whether they are secured or unsecured on the debt they extend to us and their knowledge of the underlying asset base and the airlines that they are ultimately financing. From our perspective, we manage a lot of risk. Our assets are high value and very mobile. There are huge residual value implications in the aircraft leasing business. We also deal with airlines that have in the past shown quite a lot of volatility in terms of cash flow and bankruptcy situations. So with that risk to be managed on a day-to-day basis, we take a very conservative approach on interest rate risk management. We don't need to bring additional risk into play in our business. So our own policy view is that we would ideally like to be matched or hedged at 90% or more of our debt. And for us, this simply means that we will look to ensure that the cash flows on our leases are aligned to the cash flows on the debt. We can achieve this by a number of different mechanisms or methods and products. Simply put, for everybody, in this business, a natural hedge is the most obvious solution. And by that I mean, if we have a fixed rate lease for 8 years with an airline, we will fund it with fixed year, 8-year debt from a lender. It's simple, it's transparent, it's efficient, cheap, and basically there's no documentation required.
It works.
Exactly. However, that is not always the case that this is achievable, and it could be driven by pricing or lender requirements. And our next stop is typically a plain vanilla interest rate swap. There are pros and cons to this. For the lender, it can give them greater flexibility to sell down or syndicate the debt after drawdown. From our perspective, it can also provide more efficient pricing, not just on the way in, but perhaps on the way out if we were to prepay or terminate that debt early. Some of our lenders struggle to source fixed rate dollar funding. They also may not be able to provide breakage gains and only offer breakage losses, which is not acceptable to us on a fixed rate debt. So going the interest rate swap route can be a better solution overall. We have also used interest rate caps in some of our larger ticket transactions. These probably require a bit more thought process. You do need to gauge if your board has appetite for the expenditure on an upfront premium for a cap, but they can be very, very useful, particularly in environments where you have falling interest rates, because to some extent you can buy an out-of-the-money cap at an acceptable strike level, which will provide you with protection from the downside and avail of possible upside going forward. But this is something you need to look at on a case-by-case basis. And then finally, we would, in some of our transactions, see timing exposures arise. These can be quite significant. Depending on the uncertainty level in terms of timing and the point at which we contractually commit to these transactions, we have also used interest rate swaptions and forward-starting cancelable interest rate swaps to manage and mitigate that risk. One very key point when using those instruments is that we do make sure that any costs or pricing associated with those is factored into our transaction economics, so that our board has very clear transparency as to what we are spending what we are mitigating against, and ultimately what the outcome or IRR of that transaction will be.
Great. Thanks, Catherine. So Catherine has already touched upon some of the financing considerations, which might not be directly related to the execution process, which is to follow, but linking those two can bring certain benefits. So whenever we work with companies, we would prefer to get involved into the refinancing discussions as early as possible. From our experience, law firms, which tend to use quite a bit when it comes to like refinancing, etc., they are great when it comes to having legal implications, so figuring out what legal implication, what might be one clause over the other, what is the effect from that. But sometimes they might not have the insight and the ability to quantify the impacts of having certain commercial terms over other terms. So one point we tend to come across quite frequently with this regard is the choosing of the interest rate period. So with that I mean if you, for instance, choose to pay interest 6 monthly or 3 monthly or even on a monthly basis, whilst at the first glance this might be simply a preference of paying interest more frequently versus less frequently. Companies which restrict themselves at the refinancing stage, for instance, only allow themselves to pay interest on a semi-annual basis, might end up paying a higher rate, both on the debt and then also if they decided to lock it in via an interest rate derivative. So at the top of the chart, we can see how currently the forward curve looks like for 1 month, 3 month, and 6 month GBP LIBOR, and we can see that those are priced at different levels. So normally, in a perfect world, when you think about it, everything which should be priced off the same curve, there should not be any possibility for arbitrage. So what that means is if you were able to borrow money for 3 months and then for another 3 months and lending for 6 months, this shouldn't give you any opportunity to make money. But especially since the financial crisis, the market perception of risk and in general the awareness of default has increased quite significantly. So to a bank or also a corporate, it does make a difference whether you get your interest already after 3 months and then after another 3 months, or already you agree on 6 months at the outset. So this is where the basis comes into play. So the basis is visible on the bottom chart, where we can see the basis differential for a 5-year swap. And we can see, for instance, if we look at the top line, the dark blue, which is the 6 month versus the 1 month GBP LIBOR index, we can see that during the financial crisis, the basis has peaked at 60 basis points, which means if you locked in an interest rate swap at 6 months as opposed to 1 month, it was 60 basis points more expensive per annum. So today's basis, as you can see, has come down quite significantly, but we are still at roughly 11 basis points. So when you have a 5-year swap with 100 million notional, for instance, the basis point value is approximately £50,000. So you can see that there's still, it can represent quite a big saving if you did opt for a 1 month index if your cash allows it. Another point we tend to see quite frequently are loan flaws in loan documents. What I mean by that is whenever a lender puts into like a minimum interest rate for the currencies we see in Europe quite frequently are like euro, dollar, and GBP, this is often around the mark of 0 to 1%, which basically guarantees the bank a minimum rate level at this level in case the index drops below this threshold. So the first thing you note is that basically whenever you sign a loan document with this, you've basically sold an option to the lender. And this option has a certain value. So we know that in many cases corporates won't be able to negotiate this out of their loan document, but quantifying this value we still think is quite beneficial since knowledge is power and this might allow you to get some concessions elsewhere. So if you as a corporate decided to hedge this, it makes things a little bit trickier. So first of all, if you decided to buy back this floor, this makes the instrument a lot more expensive. But if you decided not to buy back this floor and kind of have the cheaper price, your hedge between the debt and your instrument is not perfect anymore. Since with a, for instance, 1% floor, whatever happens, and if the index is below 1%, you will still be paying 1% on your debt. but on your interest rate derivative, you will be receiving a lower rate, whatever the index is, for instance, half a base, like 0.5%. So this would be an imperfect match. So the alternative potentially is to buy back this floor, which makes everything a lot more expensive. And we've quantified it, for instance, the buyback for a 5-year 100 million notional GBP loan would cost you £1.4 million extra, and for the same notional in euro terms, you would even be at almost £5 million extra. So, Catherine, is this floors in general something which affect DAE as well? And what are the other key points you come across when you negotiate the loan documentation with your lenders?
Yeah, floors are definitely something we have come across probably in 2 different ways in the past. We have seen floors being used in the term loan market, the US term loan market. As I should background or preface this by saying that we are a US dollar company. All of our exposures, all of our revenues, cash flows are dollar denominated. So it keeps it pretty simple from our perspective. But on the term loan market, we have seen floors being used as a marketing tool effectively. They are used for syndication purposes, so it gives the lenders a guaranteed return. From a treasury perspective, they are problematic because it's a variable rate piece of debt that you're trying to hedge out, but it's an imperfect hedge, as Svenja outlined, unless you are prepared to buy back that floor. And the cost of buying back that floor can be very, very expensive. So we have in the past used caps to mitigate the interest rate risk at a sort of out-of-the-money price, which gave some level of downside protection to the company with those term loans. But on hindsight, it was actually the smart way to hedge that exposure out. Because one thing we hadn't really factored in or thought of was that the term loan market is quite dynamic, and in the lifetime of some of our term loans, they have repriced once or twice within a very short period. And the repricing impacted not just on the margin, but also on the floor. So if we'd actually bought back the floor day one, we would have spent a lot of dollars up front that we would then have never seen the benefit back thereof. So whilst it was never a perfect hedge with the cap, it did give us more flexibility in that regard. We've also seen floors being introduced on our bilateral loans, and it's becoming more and more common. Even though dollars are in a slightly different interest rate environment to sterling or euro, floors are there. We typically try and push back and say, look, if you want to introduce a floor on a variable rate loan and we're swapping that back to fixed with an interest rate swap, give us symmetrical treatment on the swap so that we ensure that when we pay floating interest on the loan, we receive the exact same number on the swap.
Because apart from anything else, I'm guessing it'll give you an accounting issue, hedge accounting issue.
Absolutely, it would generate a hedge accounting issue, and commercially you are worse off.
Yeah.
That has, to some extent, got traction, but not always with all our lenders for different reasons. A second approach we've taken, which has actually been successful in a handful of cases, and maybe it just points to just a philosophical point for banks that they never want to be paying you money on a loan. The lenders have agreed to making the floor on the loan be basically at the loan margin. So our loan margin is 1.8%. It has to go negative 1.8% or below. And the cost of that embedded option is de minimis versus the cost of a floor at 0%. And that has actually worked for some of the banks. So I would encourage people to get creative, get thinking about how you can reduce this cost or take this pain away from you as a corporate treasurer. A couple of other quick key points to note with regard to negotiation and documentation is agree your credit or swap spreads, execution spreads up front if at all possible. We find sometimes our lender and swap provider, whilst nominally is the same bank, you're dealing with different departments, with different P&Ls, and what can seem like a good deal to them is not a good deal to you. Internally ourselves, we often have a lot of tension with our corporate finance team who source and negotiate a lot of the debt up front, because their goal is to get the lowest loan margin. Our goal is to hopefully get a lower swap or credit margin, because we're aware that if you were to terminate or prepay the debt, the higher the upfront swap spread, the more cost you've eaten that you can't ever get back. Whereas if you reallocate some of that cost into the loan margin, once you repay the debt, that's it. It's gone. You haven't taken the cost over the full life. And then finally, I would just touch on market disruption language. It is tending to become quite broad. I think you need to look at it carefully, because LIBOR may be a function of not being representative of bank's cost of funding due to a market-wide event, or it could be a function of a lender-specific event, i.e. a credit rating downgrade. I think it's acceptable that if the market is in turmoil and there's disruption, that you as a borrower are going to have to accept some pass-on of costs. But if it's lender-specific, you're within your rights to push back and say, no, you don't accept that. And just also, if you have lawyers working on your documentation, it may be a different lawyer on the swap versus the loan. Just make sure that language around things like market disruption is matched on both, because the default is the language may not align to what's in your loan.
Thank you. That's really helpful.
Thanks, Catherine. So now we already touched upon a bit in terms of which instruments we can use for the hedging, and we might have also taken a decision whether we buy back that floor or not. So let's think about now how do we actually go on about doing this execution of the derivative. So having worked with many different banks and also on behalf of many different clients, we can say that we can see quite a variety for the credit execution charges. Different banks would charge for one and exactly the same client. And also the mid-rate can vary quite significantly. And we tend to see this especially when the bank counterparty knows that a corporate might not have the system or the skill set to verify what the mid-rate is at the point of execution. So we are true believers that transparency is a good thing and will also help in terms of having good long-standing relationships with your bank. So I think if a corporate sees that they got screwed over once, this will most likely affect the long-term banking relationship.
Corporates have very long memories.
Yeah. So we do see the benefit of kind of managing this transparency. With many bank counterparties at hand, we do appreciate that sometimes it's a little bit difficult in terms of managing a good relationship and making every bank happy to give them business, but still achieving pricing efficiency. So one method we can see work quite well from our side is like a competitive auction. At Chatham, we managed to kind of organize it in such a way that different advisors are in line with on a telephone line with different banks at the same time. But we could also see that this is happening or also working in a treasury department, which consists of ideally more than one person. So the auction can be structured in a different way. One possibility, which might be a little bit more cutthroat than others, is the winner takes it all. So you have the full notional, give it for auction, the lowest rate gets the full chunk. An alternative to that would, for instance, be if all banks only bid on a smaller portion, for instance, 40% of the total notional, the winner gets this chunk right away, and then you offer a right to match to the second bank counterparty. If they can match, they get the second chunk. If not, then the third bank gets asked, and so on. So there could be 1,000,001 variations to structure this auction, but in general, we tend to see that very good results can be achieved in terms of pricing. One point probably to note, an auction does not work for all scenarios. So for instance, if you're having a less liquid index or less liquid currency, it might not be the best idea if like 5 or 7 banks are bidding on a high notional at the same time. So there might be, so choosing auction versus direct negotiation might become a bit more of an art than a science, but I think it certainly works to have a look at this. So, but now we'd like to hear from Catherine what her best practices are and considerations she always has to think about when it comes to interest rate execution.
Yeah, I think for interest rate execution, it depends on what we're hedging. For the bigger ticket, maybe capital market transactions, we would often look at the banks on the left lead side, also look at the relationship with their banks, because from our perspective, we need our banks to be there for us. We want them to extend balance sheet. And we know and we hear back from them that when they go to credit committee, it's good to see that the size of the wallet or the range of product offering that we're availing of with that bank is more than just direct lending. So, it's something of it's a thought process. It's maybe a little bit of back and forth. But an auction with the banks that are involved in arranging a big ticket transaction is often beneficial and perceived well by them. You also get good tension if you have an auction because you get competitive pricing between the banks, and you can allocate it against different banks proportionately or as you see fit. On a direct bilateral loan with the lender, the auction won't work. You have to just negotiate the pricing, get transparency and agreement on the bid or starting point from which you price up front. Just finally to note, we're a very small treasury team. We've got 3 people. We don't have the luxury of a front office, middle office, back office. We have found in certain instances where there are more than one banks quoting that we can get a better price and a better service if we use a company such as Chatham, who can assist us with the pricing, has systems and technology we don't have access to, that it gets a clear and good price for the company on the fixing.
So Chatham can be raised, so it's actually economically worth your while spending money with people like Chatham to get a better price.
Yes, we've had some scenarios where you might have 3 banks from a transaction and there could be spread differences of 20 basis points starting off, which is huge.
It's definitely worth employing somebody to...
100%. We have always seen value come back in terms of the basis point savings that can be achieved.
That's really helpful to understand because people can be a little bit nervous about spending money on...
Exactly.
No offence.
And I think one thing which is, of course, belongs to every execution is a bit the pre- and the post-trade documentation and regulatory process. So Carolina will give us a quick update in terms of when it comes to ISDA documentation, EMIR.
Thank you, Svenja. So when entering into interest rate transactions, you also need to consider various documentation and regulatory aspects. First of all, you will be required to document your hedging relationship with the bank, and there are 2 ways you can do it. One way is to enter into a full ISDA agreement consisting of a master agreement and an ISDA schedule, with master agreement being the non-negotiable part of an ISDA framework and the ISDA schedule being the negotiable one. ISDA agreement is executed pre-trade and sets out various legal, credit, commercial, as well as regulatory terms applicable to the parties to the hedging transaction. With an ISDA in place, parties to the hedging transaction will also need to enter into a short-form trade confirmation laying out economic details of a transaction post-trade. Another way to document your hedging relationship with the bank is through entering into a long-form confirmation post-trade. Long-form confirmation incorporates master agreement by way of reference, but it doesn't have any schedule. Instead, long-form confirmation includes less extensive list of legal, credit, and commercial terms compared to an actual ISDA. The choice between these 2 methods will depend on the bank counterparty you're facing, but also on the hedging product, as banks are generally more willing to agree to document hedging relationship via long-form confirmation for less credit-sensitive products, such as CAP with the premium paid up front. We're now going to talk about most heavily negotiated ISDA provisions, which include events leading to a termination of the hedging transactions, which you can see listed on this slide. Cross-default and credit event upon merger are both standard ISDA events. Cross-default is triggered following an occurrence of a default under the loan agreement if that default is above certain threshold. Credit event upon merger is triggered if following a merger or change of control, the creditworthiness of an entity impacted by this event is materially weaker. Additionally, a bank counterparty may want to include certain loan-linked events, which if triggered, allow them to terminate the hedging transaction. These can be divided into 3 categories. First one being linked to the term of the loan, such as premature acceleration or termination of the loan agreement, as well as partial or full repayment of the loan. Second one related to certain defaults of the borrower under the loan agreement, such as insolvency or change of control. And third one connected with the hedge provider being a lender, such as cease to be a lender event. All these events have to be carefully reviewed and negotiated to ensure that they match the structure of underlying loan agreement and that they don't impose a risk of being unhedged to you. In terms of regulatory requirements, we'll focus today on EMIR and MiFID II frameworks. EMIR, which is the European Market Infrastructure Regulation, applies to various categories of entities, including financial counterparties and non-financial counterparties above or below clearing threshold. Most corporate entities will be categorized as non-financial counterparties below clearing threshold, in short, NFC- entities. This category of entities is exempted from many EMIR compliance obligations, such as margin or clearing. However, there are certain regulatory obligations which directly apply to these entities. One of them is timely confirmation requirement, which provides that derivative contracts must be confirmed by counterparties within the second business day following a trade day. Another one is reporting, which requires each party to a trade to report more than 60 data fields, including transactional and counterparty data, to an authorized trade repository within a strict T+1 deadline. Reporting can be accomplished by reporting to a trade repository directly, delegating to a counterparty, or delegating to a third party. The last requirement is portfolio reconciliation, which provides that the counterparties have to compare key trade terms against their own records and either agree on these terms or resolve any discrepancies. Portfolio reconciliation has to be performed on a regular basis, and frequency of this process depends on the number of trades an entity has with a single bank counterparty. If that number is higher than 100, then portfolio of trades will have to be reconciled on a quarterly basis. If less than 100, then counterparties will be required to perform reconciliation once a year. The scope of EMIR obligations applicable to NFC- entities may change soon, as EMIR is currently being reviewed and European Union regulators are considering changing the regulatory framework for these entities. The proposed changes include one-sided reporting regime, whereby a financial counterparty is the only reporting party, and an exemption of intra-group transactions as long as one of the counterparties is an NFC- entity. Moving now on to MiFID II and its impact on trading. MiFID II is a Market and Financial Investment Directive which went into effect on January 3rd this year. This directive builds on existing MiFID directive and is directly applicable to MiFID investment firms. Treasury units are exempted from its scope. Despite not being directly subject to MiFID II, corporate entities will have increased indirect compliance obligations to satisfy banks' MiFID II direct compliance obligations. These include requirements imposed on the banks to obtain specific consents from clients, such as authorization to execute orders OTC, to make more disclosures to their clients, such as information about costs and charges or best execution policy, to update terms of business to include topics such as handling of client money and provision of investment advice, and to categorize clients according to MiFID II Client Categorization Framework, which establishes 4 general client classifications: eligible counterparties, professional clients, opt-out professionals, and retail clients. Our experience is that corporate entities satisfy qualitative and quantitative requirements to be categorized as professional or opt-out professional clients. Last but not least, MiFID II requires entities trading with European banks to obtain and maintain a legal entity identifier, an LEI, as failure to satisfy this requirement may result in banks refusing to trade with you.
Okay, thanks a lot, Carolina. I would have a final closing question for Catherine. So how, as a treasurer, do you cope with all this regulatory madness?
Yeah, I think this has been one of the most trying aspects of my role as a treasurer in recent years. I mean, I understand the underlying rationale is, fundamentally to protect the corporates and the non-professional clients, but the administrative and learning curve burden is quite significant, particularly with a small team. I'm sure everybody out there as a corporate treasurer has been hit with substantial documentation packs coming from their banks, covering everything from EMIR to Dodd-Frank to PSD2 to MiFID II, and it's all in theory to our benefit. But when you're a small team and you're faced with this and a lot of uncertainty around timing and implications, how do you deal with it? I certainly came to the realization that we didn't have the bandwidth to do this alone, because whilst in theory we would like to delegate our responsibilities to our banks, we have a number of banks that are based in Asia and had never heard of EMIR, let alone knew what an LEI code or UTI was. So we reached out to Chatham and engaged their services to assist with this. We knew they were in the business of advising as well, and they now help us meet all of our EMIR and Dodd-Frank regulatory requirements. And this has been the most practical solution for us and probably the most cost-efficient and time-efficient solution. And in fact, we further leveraged those capabilities because we've also designed, with their help, a quarterly compliance report that shows all of our regulatory compliance to these requirements for our derivatives. And that is something that has kept our internal audit department very happy. Another tick the box, but an important tick the box nonetheless.
Absolutely, and I know anecdotally that some corporates have told me that they have effectively one person working full-time on compliance stroke KYC requirements, and that wasn't a particularly large corporate that told me that. I think it's just an indication of the direction of travel. Ladies, thank you very much indeed for everything this afternoon. It's been very, very interesting listening to you talk. I'm going to wrap up now because I'm aware that we are to time. So I'd like to thank you all for what you've said. I'd like to thank Chatham Financial for their support. Thank you all for listening and for having joined today's session. I'm sorry if we didn't get to your question, but as you can see, we covered quite a lot of ground. A number of the questions that have come in will be responded to directly by our panelists, and others we will be covering in future sessions. Particularly, a number of questions have been raised around the future of LIBOR benchmark and the move to risk-free rates and what that might mean for interest rate risk management. That is a topic all of its own that we couldn't possibly hope to cover adequately in the time left to us today. So please watch this space. There will be a lot more coming on that, including at our annual conference. Talking of events that are coming up, you'll find details on our website. The next most immediate event is our cash management conference, which is next week in London. Please have a look at the agenda for that and register if you haven't already done so. It's invariably a very interesting couple of days. Thank you very much indeed for listening. If you could spare a moment to provide feedback on the webinar, we'd be very grateful. It helps us enormously when we're planning these things. The feedback widget, which I believe is green, is the one that you want to click, and that facility will remain open for a short while after the webinar ends. So finally, on International Women's Day, thank you to Svenja, Carolina, and to Catherine. Thank you very much indeed. Thank you all.
Thank you.
Thanks.
Thank you.